Good morning, club members. We digest world-class journalism and talk it through in plain English. Here are 5 stories worth your time. Irish lawmakers are moving to repeal the country's long-standing ban on nuclear power. The sudden change comes from the explosive growth of modern data centres. Ireland hosts the European headquarters of many global technology giants. These massive server farms already consume nearly a quarter of all Irish electricity. By 2032, their share could easily climb to 30%. Last year alone, data centre power consumption surged by 10%. Electricity demand from regular households and other businesses grew by just 2%. That enormous gap is putting severe strain on the national power grid. For decades, atomic energy was completely out of the question in Ireland. Fierce public protests in the late 1970s stopped an early nuclear project. Lawmakers then passed a formal ban on nuclear technology in 1999. Ireland relied instead on imported gas and expanding wind power. But wind power varies with the weather, while data centres require non-stop electricity. Now, the Irish Prime Minister says the government is open to exploring nuclear options. A Member of Parliament has introduced a new bill to lift the legal ban. Politicians who back the bill often point to Finland as an attractive example. Finland has a population of similar size to Ireland. Yet Finland generates nearly 40% of its total electricity from nuclear power. As a result, Finnish businesses pay the lowest electricity rates in the European Union. Irish businesses, on the other hand, face the highest electricity prices in the bloc. High energy costs make it harder for Ireland to attract and retain corporate investment. Nuclear reactors produce large amounts of electricity without creating direct carbon emissions. That makes atomic energy appealing for countries trying to meet strict climate targets. However, building a brand new nuclear plant is neither quick nor cheap. Modern reactor projects often suffer from years of delays and huge cost overruns. Managing radioactive waste also remains a sensitive political problem for any government. Even a fast decision today means years of planning before any power flows. Lifting the legal ban would not build a reactor overnight. It simply allows Ireland to explore the technology without breaking its own laws. The country faces an uncomfortable choice between its green traditions and its digital economy. Moving to our second story today, we turn from nuclear power to the world of big money. American financial giants are buying up European investment managers at the fastest pace in decades. So far this year, US takeovers in the sector have topped $14 billion. That is the highest level of deal-making since records began in 1995. American buyers include rival fund managers, giant insurance firms, and private equity groups. Why are venerable European financial houses suddenly selling out to Wall Street? The central problem is that running a traditional fund has become far more expensive. For years, cheap passive funds have steadily driven down the fees managers can charge. These passive index funds simply track the wider market at very low cost. To compete, traditional managers have had to cut their own prices year after year. Meanwhile, the cost of financial regulation and modern computer systems keeps rising. That leaves European firms with shrinking profit margins on the money they manage. Wealthy clients and pension funds also want everything under one roof now. They prefer dealing with a single giant manager across all asset classes. Big American firms can easily provide that one-stop service. To survive in this environment, fund managers need sheer scale. Size allows a company to spread huge technology costs across millions of client accounts. Large firms also get far better shelf space on retail investment platforms. American giants already hold a massive home advantage here. They can build enormous funds within their vast domestic market before expanding abroad. As a result, American groups are steadily conquering the European market. US managers now control 47% of all European fund assets. 5 years ago, that share was only 40%. In the exchange-traded fund market, American firms now control 64%, yet the reverse flow simply does not exist. Non-American firms hold less than 1% of the US market. That financial power makes large European takeovers look relatively routine. Earlier this year, an American buyer snapped up the British asset manager Schroders. That single takeover was valued at nearly £10 billion. Some European bosses insist that joining a mega firm is not the only answer. They argue that smaller firms can survive by offering deep, specialist expertise. The real danger is for the firms caught awkwardly in the middle. If a manager lacks both giant scale and a sharp speciality, trouble lies ahead. For those firms, an American buyout may soon be the only way out. For our third story, we move from European finance to the classrooms of South Korea. A surprising shift in ambition is taking place across the country. For decades, the most talented students in South Korea wanted to become doctors. Medicine offered guaranteed wealth, social respect, and a steady career for life. Today, that long national tradition is suddenly breaking down. Thousands of university students are rushing into private cram schools to study microchips instead. Why are engineering classes suddenly beating medical schools in popularity? The answer comes down to eye-catching worker bonuses fueled by global demand for AI. South Korea produces most of the world's advanced memory chips. The two largest manufacturers, Samsung and SK Hynix, are earning record profits. Both tech giants have agreed to share those massive earnings with their staff. At Samsung, average bonuses in the memory division could approach $400,000. At SK Hynix, workers might take home around $500,000 this year. Those enormous sums have completely changed how families view an engineering career. In recent university admissions, chip-making programs attracted more applicants than medical schools. At the same time, applications for medical degrees dropped by nearly a third. Across Seoul, specialized academies are packed with eager students all summer. Many spend 8 hours a day studying chip design, component testing, and data analysis. Former industry engineers lead practical sessions and prepare candidates for job interviews. Some academies even promise full tuition refunds if a graduate gets hired. The rush for these positions is intense. Youth unemployment in South Korea recently climbed above 7%. Large conglomerates offer the best wages, but they provide only a fraction of all jobs. Competition is so fierce that some university graduates hide their degrees to get factory work, yet university professors warn that this gold rush carries real risks. The semiconductor industry has always moved in sharp cycles of boom and bust. Huge profits can disappear quickly whenever global technology spending cools down. For now, an entire generation of Korean students is betting on the memory chip boom. The remaining uncertainty is whether those historic bonuses will still be there when they graduate. For our fourth topic, we move from South Korean classrooms to the global oil market. India is now buying more Russian crude oil than ever before. In June and July, more than half of India's imported oil came from Moscow. That equals more than 2.6 million barrels every single day. Just a few months ago, that number was less than half as high. So what triggered this sudden shift back to Russian energy? The main reason is the continuing conflict across the Gulf. Fighting in the Middle East has sharply reduced tanker traffic through the Strait of Hormuz. That bottleneck left global markets short of supply. India was hit especially hard because it imports over 90% of its oil. Earlier this year, Washington had pressed New Delhi to stop buying from Russia. American officials argued that those purchases helped fund the war in Ukraine. India did cut back for a short time. However, as Middle Eastern supplies dried up, the United States issued special waivers. Those waivers allowed Indian refiners to buy Russian barrels without facing penalties. Indian leaders felt they had very little choice. Fossil fuels still provide nearly 90% of the country's total energy. Coal alone accounts for 60%, while oil makes up 28%. Prime Minister Narendra Modi recently called energy security the need of the hour. He wants India to build more renewable power and expand private nuclear energy. Yet experts point out that an energy transition cannot happen overnight. For now, everyday life in India depends on imported fuel. Cooking gas is a prime example of this vulnerability. Hundreds of millions of Indian families rely on gas cylinders to cook their meals. Indian refineries have increased gas production to meet demand. Even so, almost all of that cooking gas is refined from imported crude. To protect itself, the Indian government is expanding its strategic petroleum reserves. Together with commercial storage, India now holds about 74 days of oil supply. It is even exploring storage facilities inside the United Arab Emirates. Still, reserves for gas remain far smaller than reserves for oil. This leaves the country exposed whenever shipping routes shut down. India has kept its lights on by turning back to Moscow. The real test is how quickly it can build a safer energy system. For our final story today, we turn from global oil to high-stakes stock markets. Over the past 2 months, computer chip shares have suffered a painful downturn. Giant technology companies are pouring hundreds of billions into artificial intelligence equipment. For a long time, chip makers rode that wave of excitement to record highs. Recently, however, investors began to question the real profits behind the boom. As those doubts spread, semiconductor share prices tumbled across global exchanges. Usually, a sudden collapse makes ordinary buyers step back and wait. Yet millions of small traders did the exact opposite this summer. Retail investors poured billions of dollars into high-risk, leveraged exchange funds. These aggressive financial products use derivatives to amplify everyday market movements. When an underlying index goes up, the fund triples the daily return. When the index falls, the fund also triples the daily loss. When prices swing wildly back and forth, these funds quickly lose value. Even a modest rebound often fails to repair that sudden mathematical damage. The largest semiconductor fund took in nearly $7 billion during the sell-off. That massive rush of money arrived even as the fund plunged 70%. Single stock funds tracking individual chip makers suffered even heavier damage. One fund linked to South Korean memory giant SK Hynix sank 86%. Another product tied to American memory maker SanDisk lost 85%. Many retail traders still believe they were grabbing a rare bargain. Traders often call this aggressive tactic buying the dip. They hope to buy at the bottom and sell during a sudden rally. Market analysts warn that this approach is like trying to catch a falling knife. In South Korea, these extreme trading products became immensely popular among small investors. The rapid decline caused over 1 million Korean accounts to trigger margin calls. Brokers demanded immediate cash deposits to cover the mounting borrowed losses. Korean authorities quickly introduced strict trading caps and mandatory training courses. Despite those official warnings, small investors are still hunting for quick rebounds. The speculative froth may have thinned, but the risky trading habits remain unchanged. Whether these daring bets will pay off remains an expensive guessing game. That brings us to the end of today's stories. Thank you for sharing your breakfast with me, and I will see you tomorrow morning.